A $25 billion U.S. Treasury auction recently stumbled as foreign demand dropped sharply to just 58.9%. This caused yields to spike, signaling a pullback from international investors on U.S. debt. At the same time, in a surprising move, Trump slashed tariffs on Chinese goods from 145% to 80%. No deal, no negotiations. Just a sudden policy shift quietly handed over to Treasury Secretary Scott Bauman under pressure from volatile markets. Why did the U.S. have to pay higher borrowing costs with fewer buyers at the May 9 30-year bond auction, which closed at a 4.82% yield, much higher than expected? Bloomberg reported a steep drop in foreign bids, falling well below the 6-month average. Even trusted allies like Japan showed hesitation, offloading $36.6 billion in U.S. Treasuries in March alone. This auction failure followed Trump doubling down on the 145% tariffs on Chinese imports, sparking fears of persistent inflation and retaliation disrupting supply chains. Rising bond yields mean the cost of managing America's record $34.66 trillion national debt is ballooning, with interest payments expected to top $1 trillion by 2025. This wasn't just a weak auction. It's a warning that the world might be stepping back from funding Washington's economic battles. Just 3 days later, Trump unexpectedly lowered tariffs on China to 80%, not due to any deal but announced via social media. Beijing remained silent and confident, refusing to retaliate or match tariffs. Analysts see this sudden cut as a sign of economic stress inside the White House rather than a genuine compromise. China's April customs data revealed a contradiction. While exports to the United States dropped 21.2% year-over-year, overall exports still rose 8.1%, driven by a 23% increase to Southeast Asia and an 8% rise to the European Union. China isn't just dodging tariffs, it's expanding market reach. Experts highlight how Chinese companies are rerouting goods through third countries or focusing on non-U.S. markets. Former IMF China Division head Izar Prasad says this adaptability is turning into industrial strength, weakening the logic behind American sanctions. U.S. officials promote reshoring to cut foreign dependence, but data tells a different story. In the first quarter of 2025, Vietnam imported $30.2 billion worth of Chinese goods, a 26% increase, while its exports to the U.S. surged, raising concerns about transshipment, where Chinese goods are relabeled in third countries to evade tariffs. The situation with critical materials is even more troubling. China cut exports of gallium and germanium by 16%, pushing up costs for industries like EV batteries and missile systems. The U.S. still depends heavily on China for rare earth elements, with over 80% of its supply sourced there, though increasingly through costly and unpredictable channels. Washington's efforts to reduce reliance on China are getting tangled in complex hidden supply chains. On May 8th, during a tense House Financial Services Committee hearing, Treasury Secretary Scott Bauman was directly asked, who actually pays the tariffs? His answer: it's complicated, but markets don't tolerate uncertainty. This candid admission, clipped and broadcast by CNBC, triggered a major shock to financial markets. According to FactSet data, the VIX Volatility Index surged 7.4% over the following 36 hours. Meanwhile, the S&P 500 wiped out earlier gains and closed down 1.6%, a surprising drop on tariff news many expected would spark a rally. The bond market, already fragile due to weak auction demand, reacted with added risk premiums, pushing the 10-year Treasury yield to 4.39%, its highest since November. Analysts like Stephen Olson, a former U.S. trade negotiator, say Bauman's inability to clearly explain tariff mechanics deepens global doubts about the coherence of U.S. trade policy. This uncertainty is not theoretical. Investor confidence is crumbling in real time, not because of ideology, but because the official in charge can't justify the policy's financial logic. The debt market is losing patience and no longer giving Washington the benefit of the doubt. In April 2025, China slashed global rare earth exports by 16%, shipping just 4,812 metric tons, the lowest monthly total since 2019. The cuts targeted gallium, germanium, and antimony, minerals the U.S. Geological Survey confirms are vital for semiconductor manufacturing, electric vehicles, and missile guidance systems. Bloomberg reported that China's Commerce Ministry tightened export controls on these materials, citing national security concerns. U.S. manufacturers relying on neodymium magnets for EV motors are now paying 28% more per kilogram compared to 6 months ago. The Department of Defense acknowledged in April that 83% of its strategic mineral imports come from China or China-controlled sources in Africa. Meanwhile, Treasury Secretary Bauman faces mounting pressure in Geneva to negotiate relief on rare earths as part of tariff de-escalation talks. But Beijing insists that any easing of export controls depends on a full rollback of U.S. tariffs. So the U.S. is entering talks seeking critical materials while still enforcing import duties as high as 145%. How can that deal close? On May 7th, former President Trump surprised markets by proposing to reduce tariffs on Chinese imports from 145% down to 80% without diplomatic explanation. This announcement shifted responsibility to Bauman amid 3 weeks of weak bond auctions and reports that U.S. retailers' freight costs jumped 22% in April as companies scrambled to replace disrupted Chinese supplies. China's Ministry of Commerce did not respond in kind, reiterating their stance that negotiations must begin with the U.S. fully removing tariffs. Ezar Prasad, former IMF China director, told Bloomberg TV that a unilateral tariff cut without reciprocity signals. Washington's moves are driven more by inflation worries than geopolitical strategy. Bauman faces a tough contradiction. His side is essentially negotiating with itself while Beijing waits for a stronger offer. If this is a bluff, it's a costly one. Trump's May 6th announcement of a new trade deal with the UK grabbed headlines, but tells a different story on closer look. The deal offers tariff-free Rolls-Royce engines and more beef exports, but raises the average tariff on British goods from 3.4% to 10%. Though it opens $5 billion in new U.S. agricultural exports and British Airways announced a $10 billion Boeing order, these wins are offset by tariff hikes looming over 90 countries, including China. Stephen Olson said, "This deal works with allies but doesn't apply to adversaries with leverage." Calling it a model for China isn't just premature, it's fundamentally flawed. Howard Lutnick, Commerce Secretary, offered a rare behind-the-scenes glimpse, saying the administration might settle on tariffs with China around 34%, describing it as a human level that allows business to continue. That number is significant. Trump first proposed it during his 2019 tariff campaign. The tax foundation estimated it could reduce U.S. GDP by 0.8% to 8% annually if kept long-term. Compared to today's 145% tariffs, 34% seems moderate but still quadruples pre-trade war levels. The Peterson Institute warns even a 34% tariff on key goods could add 1.3% to core inflation and slash global trade by $430 billion annually. More importantly, it wouldn't stop companies from bypassing tariffs through Southeast Asia, where Chinese parts are re-exported to the U.S. with little oversight. The real question isn't if 34% is politically possible. It's whether it makes economic sense in a supply chain world that ignores borders. Bauman arrived in Geneva demanding mineral access while defending tariffs that block supply. China entered selling goods at a record surplus despite sanctions and without asking for relief. Now, the U.S. is caught between two growing crises, a bond market nearing collapse and a trade war strategy showing clear weaknesses. The 80% tariff is still unofficial, the 34% compromise uncertain, while debt auctions and inflation won't wait. Here's the big question. What if China doesn't back down again? And what if buyers stop buying U.S. debt this time? Thanks for watching. Please like and subscribe, and check out another video on your screen now. Stay tuned for more hot news from Legit Geo News. Catch you in the next one.